Hey there, future millionaires! Ever wanted to own a piece of your favorite company? That's what the stock market is all about. Think of it like a giant marketplace, but instead of selling clothes or gadgets, they're selling pieces of businesses. These pieces are called stocks. Intrigued? You should be. Let's dive in. The stock market is where buyers and sellers come together to trade these stocks. It's buzzing with activity, kind of like a beehive, but instead of honey, it's all about making or losing money. Don't worry, we'll navigate this exciting world together, step by step. This isn't some exclusive club for Wall Street hotshots. You too can join the action. Whether you're a seasoned pro or just starting, understanding the stock market can empower you to grow your wealth over time. Ready to take charge of your financial future? Let's do this. Alright, let's break down what stocks actually are. Stocks, also known as shares or equities, represent ownership in a company. When you own a stock, you own a piece of that company, no matter how small. Imagine your favorite pizza place. It's a cozy spot where you love to hang out with friends and enjoy delicious slices of pizza. Let's say they want to expand and open a new location. To do that, they need money, right? They could take out a loan, but another way is to sell ownership in the business to raise funds. So, they divide ownership of their business into tiny slices, like slices of pizza. Each slice represents a portion of the company. Each slice represents a share of the company, also known as a stock. These shares are then sold to investors who want to own a part of the business. When you buy a stock, you're essentially buying a tiny slice of ownership in that company. This means you have a claim on part of the company's assets and earnings. You become a shareholder, a part owner. As a shareholder, you may also have voting rights on certain company decisions, depending on the type of stock you own. Now, if the pizza place does well, your slice of the pie, your stock, becomes more valuable. The value of your shares can increase, and you might even receive dividends, which are a portion of the company's profits paid out to shareholders. But just like any good pizza party, there are risks involved. The value of your stock can go up and down based on how well the company performs and other market factors. If the pizza place messes up, maybe they use pineapple, gasp, the value of your slice could go down. Poor business decisions, competition, and economic downturns can all negatively impact the value of your stock. Don't worry, we'll talk more about managing risk later. It's important to understand that investing in stocks requires careful consideration and research. For now, just remember, owning a stock means you own a piece of a company and its future. It's a way to potentially grow your wealth, but it comes with its own set of challenges and rewards. So we get why you might want a slice of the pie, but why would a company want a share? Good question. Companies sell shares of their business to the public for several reasons. Remember our pizza place wanting to expand? That's one reason, to raise money for growth. This process of selling shares to the public for the first time is called an initial public offering, or IPO. It's kind of like a grand opening for their stock. By selling shares, they can raise capital to invest in new projects, research and development, hire more employees, or pay off debts. Going public also gives the company more exposure and credibility. Think of it like winning a pizza competition. More people know about them, which can attract customers, investors, and even talented employees. It's a win-win for everyone involved. Now let's talk about how stock prices move. Remember the law of supply and demand? It's like that super popular pizza place everyone's talking about. If everyone wants a slice, high demand, but there aren't many slices left, low supply, the price goes up. The same goes for stocks. If a company is doing well, people get excited and want to buy their stock. This high demand pushes the price up. On the flip side, if a company isn't doing so hot, investors might sell their shares, increasing the supply and driving the price down. It's a constant dance between buyers and sellers, influenced by news, company performance, economic factors, and even just plain old investor sentiment. Understanding this dynamic is key to making smart investment decisions. Section 5: Stocks versus Savings, Baking Your Dough Grow. You might be thinking, why not just keep my money in a savings account? Well, while savings accounts are safe and offer a small return, investing in stocks has the potential for much higher returns over the long term. Think of it like this. You can store your dough in the fridge, or you can bake it into a delicious pizza that could potentially double or triple in size. Of course, with higher potential returns come higher risks. Stock prices can be volatile, meaning they can go up and down, sometimes dramatically. That's why it's crucial to diversify your investments, which we'll discuss more later. The key takeaway here is that investing in stocks, while riskier than savings accounts, offers the potential for your money to grow at a much faster rate over time. Section 6. Bulls, bears, and diversifying your plate. Let's learn some stock market lingo. When the market is doing well and stock prices are generally rising, it's called a bull market. Think of a bull charging forward with its horns up. Conversely, when the market is declining and stock prices are falling, it's called a bear market. Picture a bear swiping its paw down. Now let's talk about diversification. Remember how we said it's important not to put all your eggs in one basket? It's the same with investing. Diversifying your portfolio means spreading your investments across different companies, industries, and asset classes. Think of it like having a variety of pizza toppings. If you only like pepperoni and it goes bad, your whole pizza is ruined. But if you have a mix of toppings, you're covered. Diversification helps reduce risk and protect your investments from market fluctuations. Section 7. Ready to invest? Your first bites. Feeling ready to take the plunge? Fantastic. Investing can be an exciting journey, but it's important to approach it with a clear plan and a calm mindset. Here are some steps to get you started. First, set your goals. Think about what you want to achieve with your investments. What are you saving for? Retirement? Maybe you want to ensure a comfortable future for yourself and your loved ones. A down payment on a house? Owning a home can be a significant milestone and a solid investment in your future. Having clear financial goals will guide your investment strategy. Second, do your homework. Educate yourself about the market. Learn the basics of investing. Understand different types of investments and how they work. Research different companies and industries and look into their performance history. Understand the risks involved. Knowledge is power. Third, pick a broker. This is your gateway to the stock market. You'll need a brokerage account to buy and sell stocks. Look for a broker that fits your needs. Choose a reputable online broker with low fees and a user-friendly platform. Fourth, start small. You don't need a ton of money to get started. Even small amounts can grow over time with the right strategy. Begin with a small investment amount that you're comfortable with, and don't rush into big decisions. Gradually increase it over time as you become more confident and knowledgeable. Finally, diversify. Don't put all your money into one stock or industry. Diversification is key to managing risk. Spread your investments to minimize risk and maximize potential returns. Think of it as not putting all your eggs in one basket. Remember, investing is a marathon, not a sprint. Be patient, stay informed, and keep an eye on your long-term goals. And don't be afraid to ask for help if you need it. Consulting with a financial advisor or joining investment forums can provide valuable insights and support. Section 8. Patience, young Padawan, investing for the long haul. Investing is a journey, not a sprint. It's about making informed decisions and staying the course, even when the waters get choppy. Here's a secret. Investing in the stock market is not a get-rich-quick scheme. It's a marathon that requires endurance and a clear strategy. Many people get discouraged when they don't see immediate returns, but the key is to stay committed. It requires patience, discipline, and a long-term perspective. Just like a gardener tends to their plants, you need to nurture your investments. Regularly review your portfolio, but avoid the temptation to make impulsive changes. Don't expect to get rich overnight. The stock market is unpredictable in the short term, but history shows that it rewards those who stay invested over the long haul. Think of it like growing a pizza dough. It takes time to rise and bake to perfection. Just as a baker waits patiently for the dough to rise, you must give your investments time to grow. Avoid making rash decisions based on short-term market fluctuations. Emotional reactions can lead to costly mistakes. Instead, focus on your long-term goals and stick to your investment plan. Remember, the stock market goes up and down, but over the long term, it has historically trended upwards. This upward trend is driven by economic growth, innovation, and the resilience of businesses. Stay focused on your goals, ride out the ups and downs, and let the power of compounding work its magic. Compounding is the process where your investment earnings generate their own earnings, leading to exponential growth over time. Investing in the stock market can be an exciting and rewarding journey. The thrill of seeing your investments grow and the satisfaction of achieving your financial goals make the journey worthwhile. By understanding the basics, managing your risk, and staying patient, you can set yourself up for financial success. Diversification, or spreading your investments across different assets, can help manage risk and improve your chances of long-term success. So, go out there, grab your slice of the pie, and start investing in your future today. The sooner you start, the more time your investments have to grow. Happy investing!